Over IRS Form 8889, Health Savings Accounts. So this is an attachment to your Form 1040, 1040SR, 1040NR. So this would be something that at the end of this form, you'll know whether or not you owe any taxes on your HSA contributions and distributions. We'll also know whether or not there's any additional penalties that may apply. So as we walk through this one-page form, we'll kind of talk about some of the limitations and all of the things that may impact the tax benefit of your HSA. So before we begin with the form, just a brief overview. A health savings account is a type of savings account that your employer can set up that works hand in hand with a high deductible health plan, otherwise known as an HDHP. So if you work for an employer that does not provide an HDHP, then you're not eligible to contribute to an HSA. So there are a lot of people that have HSAs from prior jobs, and you can keep that. You can invest that money. You can let that money grow over time. But unless you have an HDHP, you cannot make further contributions to that plan. And then there are certain limitations on how the tax. There are certain limitations that will tell you whether or not distributions are taxable. So if you make distributions correctly according to the tax code on qualified medical expenses, then the goal is to pay zero money on your HSA contribution or your deduction. And finally, one last thing, health savings accounts are known as a triple tax benefit arrangement. It's the pretty much the only major retirement savings vehicle or similar savings vehicle where your contributions are made before taxes, so you're not you're paying with pre-tax money. Your taxes are deferred while you're investing in that account, so you can have this account growing over a very long period of time, and you will never pay taxes on the money as long as it's in the account. And finally, you're eligible for tax-free withdrawals. So this is a better savings tool than even a Roth IRA, because in a Roth IRA, all of your contributions are made with after-tax money unless you get into very specific circumstances. So in general, pre-tax money goes into the health savings account. The taxes are deferred as long as the money stays in the account. And when the money is withdrawn, as long as it meets the criteria for being spent on qualified medical expenses, then it's tax-free. And it's primarily the only major savings plan that allows you to do that. So we've pre-filled this form. Our hero, John Doe, is completing his HSA or his Form 8889 for his tax return. So there are three parts. Part one is the HSA contributions and tax deduction. Part two is the HSA distributions. And finally, part three is any income tax and additional tax for failure to maintain HDHP coverage. So let's go up to part one. This is the most significant part. So you're going to check the box to indicate your coverage under a high deductible health plan during the tax year. So for 2023, there are limitations specifically on minimum deductibles as well as maximum out-of-pocket costs. So you would check either self-only or family. In this case, John Doe, his name is up here, his social security is up here, and then we're checking the self-only box. Now, if you were filing a joint tax return and you and your spouse both have separate HSAs, then each spouse would complete part one separately. So for the 2023 tax year, it looks like the maximum contribution limit is $3,850. So in this case, we we made contributions for $3,600. That's $300 a month, and that came out of John's paycheck, and that goes into line 2. So that doesn't include employer contributions, a cafeteria plan contribution, or HSA rollovers. We'll get to those in subsequent lines. These are simply the contributions that you made during the tax year, or contributions that someone else made on your behalf. You can find that information probably after the fact on IRS Form 5498 HSA, which is a informational tax return that's done after the tax filing deadline that shows what your HSA contributions were. In line 3, we're going to enter the limitation for persons under the age of 55 during the tax year. So if you had single coverage, you would put $3,850. For family coverage, you would put $7,750, and that's the maximum contribution. Assuming you had coverage starting on the first day of every month during the tax year, and you had the same coverage. So if you had, months where you didn't have HDHP coverage, then there's additional information. There's a worksheet in the form instructions that you would have to complete because your maximum contribution limit would be limited. So it would be less than the $3,850 or the $7,750. In line 4, you're going to put in any Archer MSA contributions. Archer MSAs are similar to HSAs. They're kind of like the predecessor to an HSA. You would see IRS Form 8853 that reports Archer MSAs. So if you had an Archer MSA and you contributed during the tax year, then you need to include that because this maximum contribution limit includes HSAs and Archer MSAs. So if your spouse had family coverage, you would also include any amount that went into your spouse's Archer MSA. So in this case, John Doe does not have an Archer MSA. So we subtract line 4 from this amount, and our maximum is still $3,850. So now we're going to carry the $3,850 from line 5. However, the line 6 instructions specifically state that if you and your spouse have separate HSAs and you had family coverage under an HDHP, then you would take that $7,750 and you can split it any way that you and your spouse deem to be fit. So you can split it 50-50. You can put majority of it on one spouse or the other. So any combination, as long as the total is less than the maximum family contribution limit. So if you and your spouse both have an HSA and you both have family coverage, you can't double dip and contribute the max family plus your spouse contributing the max family. Your combined amounts have to equal the maximum family contribution. So this is the line where you would just annotate your split. So for example, if John had a wife and they, between the two of them, contributed the full $7,750, if his wife decided to take $4,000, then he would only be able to enter $3,750 in here. If you're age 55 or older at the end of the year, if you're married and you and your spouse had family coverage under an HDHP, you can enter an additional contribution amount based on the form instructions. Let me pull them up here for a quick reference. So basically, you have to go through an additional contribution worksheet. If you're eligible for all 12 months, your maximum is $1,000. Any number of months less than that, say it's a prorated contribution limit. So let's say you were covered under an HDHP for 6 months out of the year. Instead of the $1,000, you'd be eligible for an additional $500 contribution. So in this case, John Doe isn't eligible for any additional contribution, so we just entered 0. We're going to total that up in line 8. This represents the maximum that you can contribute before any employer contributions and before any HSA funding distributions. So line 9 is exactly that. Employer contributions made to your HSA. So between yourself and your lawyer or your employer, your contribution maximum is this amount on line 3 with all of these adjustments. So if your employer is putting all this money into your HSA, then you don't get to. It's great because you have full use of that money that you would have put into an HSA, but you don't get the tax benefit of, your pre-tax contribution. So so in this case, John Doe, he's got 0, and then he also has 0 qualified HSA funding distribution. So a qualified HSA funding distribution is a one-time distribution from a IRA or a Roth IRA in what's known as a trustee-to-trustee transfer. So if you decided to take this year's funding distribution out of your traditional IRA, you can do that. You can put this here. It's a one-time benefit, and you can only go to that year's maximum. So for family coverage, that would be the $77.50. For the single self coverage, it would be $38.50. And again, that's once per lifetime per taxpayer. So now the difference between the traditional IRA and the Roth IRA, if you think about it, you have the ability to take some pre-tax money possibly out of your traditional IRA and move it over into an HSA where it will never be taxed. Whereas with the Roth IRA, the money is going to grow tax deferred and more likely than not, unless you break the early distribution rules on a Roth IRA, you'll be able to eventually take that money out for tax free. So just a quick tax tip: if you're considering making a qualified HSA funding distribution, you should take a look at the options of doing so from a traditional IRA instead of a Roth account. So on line 11, we're going to total these up. Turns out to be 0, but then you're going to subtract that from the line 8 amount, and that represents the maximum that you would be able to contribute. So in this case, these are all zeros. We're still at the cap of $38.50. We're going to enter the smaller of either the cap or the actual contributions. So on Schedule 1, we're going to put on line 13, we're going to put the 3,600. That's on Part 2. So that's the deduction for our HSA deduction. If the line 2 amount, which is the actual contributions, is more than line 13, you might have to pay an additional tax. And so that's the additional tax on over contributing. In Part 2, we're going to talk about distributions. So let's imagine John Doe had $5,000 in distributions from all HSAs, which happens to be his one HSA. You would put that total amount in line 14A. In line 14B would be any distributions that you rolled over into another HSA. So you would also include any excess that were withdrawn. Basically, these are non-taxable distributions, so you would back that out. So the total distributions, we didn't have any rollovers, we didn't have any excess distributions, so that's 0. Our maximum distributions is $5,000. In line 15, we're going to enter the actual qualified medical expenses. Generally speaking, this is any qualified expense that you would normally be able to deduct on Schedule A, as well as certain things like non-prescription medications, COVID supplies, certain feminine hygiene products, and certain insurance premiums. So I won't go into that much detail. We do cover down on all of the details in our article, and I'll give you directions in just a moment on how to get to our article. In line 16, we're going to subtract line 15 from line 14. In this case, since our qualified medical expenses exceed our HSA distributions, that amount is 0. We're going to put that into part 1 of Schedule 1, line 8F. So our Schedule 1 basically reads 0 additional income and then $3,600 as an above the line adjustment to gross income. So that's a top of the line, or that's an above the line deduction, and that means that it reduces our adjusted gross income. In line 17, if for some reason we had distributions on line 16, we would have to determine whether or not any of those distributions met one of the exceptions to the 20% tax. So that includes death of a beneficiary that turns age 55 or older, or a beneficiary that, there's one last exception, becomes disabled. So if there's a death, disability, or if they become legally able to, like age 55 or older, then they're not subject, that account is not subject to the additional 20% tax. So let's just imagine that John Doe, these numbers were reversed. He actually had $5,000 worth of medical expenses and $6,000 of withdrawals. That would mean that he would have an additional $1,000 of taxable income that gets reported on Schedule 1. If those distributions did not meet the additional 20% tax, then he would need to multiply this amount by 20% down here. So that extra $200 goes on to Schedule 2, which is the additional taxes form. Of course, if he can have that $1,000 excess withdrawal, and if he meets that 20% tax, then he's not subject to the penalty. He would simply pay ordinary income tax on that difference, the $1,000 withdrawal over the qualified medical expenses. So you can kind of see how managing this form, you can manage your expenses and use this form to make sure that you're not paying any income tax unnecessarily. Part 3 only applies if you don't have HDHP coverage for the entire year. So we'll kind of talk about what the last month rule means. The last month rule basically means that you're considered to be fully involved in an HDHP or covered by an HDHP for the entire year, as long as you still have coverage on the first day of the last month. So if it's a normal tax year and the last month is December, as long as you have coverage that goes through December 1st, you're considered to have met the last month rule. If you don't meet the last month rule, then you have to prorate. So, if you have 6 out of 12 months of coverage, then you would have to do calculation to prorate any additional tax that you may have to pay. Same with the qualified funding, HSA funding distribution. Again, that depends on your maintaining a high deductible health plan for the entire year. So in our article, we do break these two steps down a little bit more detail. In this case, in John Doe's case, we don't have any of those types of income items, so we're not completing this form. But if you did, you would add lines 18 and 19. This line goes on Part 1, line 8F of Schedule 1, and then you would multiply this by a 10% additional tax. So this is not the HSA distribution tax, this is an income tax plus an additional penalty because you did not maintain that HDHP coverage while you were making those funding distributions or contributions. So the qualified funding distribution actually is the distribution from a retirement account into your HSA. So all of these, if you do this as you outlined, as you plan at the beginning of the year, and your expenses exceed your distributions, as long as you don't over contribute and as long as you maintain coverage for the entire tax year, you're most likely going to be able to not have to report anything on Schedule 1 or Schedule 2. So that's all we have for this video. As I mentioned, we do break down this tax form in a little bit more detail in our article. So we have the link in our show notes. We'll also, but you can also get there by going to teachmepersonalfinance.com, type in IRS form 8889, and you should see the article up here. So we'll put links in the show notes to all the articles and videos that we've created about some of these other forms and schedules mentioned in this video. If you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.